The 2x Long VIX Futures ETF, also known as UVIX, is a unique investment option for those seeking to profit from market volatility. This exchange-traded fund, or ETF, seeks to provide investors with twice the daily return of the CBOE Volatility Index, also known as the VIX. But what exactly is the VIX and why is it important for investors to understand? The VIX is a measure of the expected volatility of the S&P 500 index, which is a commonly used benchmark for the overall performance of the stock market. It is calculated using options prices on the S&P 500, with higher options prices indicating a higher level of uncertainty or risk in the market. The VIX is often referred to as the fear index, as it tends to rise during times of market uncertainty or market declines. Conversely, it tends to fall during times of market stability or market gains. This is where UVIX comes in. By tracking the daily return of the VIX, UVIX allows investors to potentially profit from market volatility. For example, if the VIX rises due to market uncertainty, UVIX may also rise, providing investors with potential gains. However, it is important to note that UVIX is a highly speculative investment and should only be considered by those with a high risk tolerance. Due to its leveraged nature, UVIX is much more volatile than traditional ETFs and can result in significant losses if not managed carefully. Additionally, UVIX is not suitable for long-term investment strategies, as it is designed to track the daily return of the VIX, not the long-term performance of the market. It is best used as a short-term, tactical investment tool to potentially profit from market volatility. So how does UVIX work? UVIX is structured as a futures-based ETF, which means it uses futures contracts to achieve its investment objective. Futures contracts are agreements to buy or sell a particular asset at a predetermined price in the future. In the case of UVIX, the ETF holds a portfolio of VIX futures contracts, which are purchased and sold based on the daily return of the VIX. By holding these futures contracts, UVIX aims to provide investors with twice the daily return of the VIX. However, it is important to note that the daily return of the VIX can be highly volatile, and this volatility is magnified in UVIX due to its leveraged nature. As a result, UVIX can experience significant price fluctuations on a daily basis, which can result in significant losses for investors. One potential risk for investors in UVIX is the potential for a contango market. Contango occurs when the price of a futures contract is higher than the expected spot price of the underlying asset at the time of expiration. This can result in losses for UVIX, as the ETF must continuously roll over its futures contracts to maintain its investment objective. Additionally, UVIX is subject to the risk of tracking error, which refers to the difference between the performance of the ETF and the performance of its underlying benchmark. In the case of UVIX, tracking error can occur due to the complexities of the futures market, which can result in deviations between the ETF's performance and the performance of the VIX. Despite these risks, UVIX can still be a useful investment tool for those seeking to profit from market volatility. However, it is important for investors to thoroughly understand the risks associated with UVIX and to carefully manage their investments to minimize potential losses. In conclusion, the 2x Long VIX Futures ETF, or UVIX, is a highly speculative investment that seeks to provide investors with twice the daily return of the CBOE Volatility Index. Happy investing!